Thank you everyone for attending this session. Uh, just before starting, I just want to tell you that I will count on your high interaction because this is more of a training rather than lecturing. So I will be asking questions very often. And whenever you have a question yourself or an answer, you can just release your mic, say your first name, then you start speaking, okay? Don't raise your hand because I will be just displaying the slides on a full screen mode because I might be writing on some of them. So you need just to release your mic and say whatever you wish anytime. So basically for today's session is about an introduction to your next home assignment, which is about financials. Now, you need to know that financials is a broad topic that includes decisions ranging from accounting to financial decisions to capital budgeting decisions. So it's pretty broad. But what we need from you at this stage is more of cash budget. Why? Because we'll see that cash is very crucial at this stage, especially in the type of your companies that are startups or pre-startups, and we'll see how we can do this in a perfect manner. Now, basically, I want to check just your basic knowledge of accounting and what do you know about accounting. If you can share with me, whatever your background is, what do you know about accounting and different concepts that you know about accounting, and we can take it from there. Anyone? People, you are sitting here. Anyone?
Let's see the chat.
Yeah, this is
Yes,
Yeah.
I know just difference between corporation and company.
Good, good. So starting from that, that will be a good start. So basically, you are talking here about the types of businesses. So yes, you mentioned corporation and the company. So we need to know that we have three main types of companies. So we have what we call the sole, where you have one owner, and we have partnerships, and we have corporations. Now, basically, for corporations, I doubt that this will be a type of your company or your startup for the time being, but I would say that your companies might be more of partnerships or souls. Now, for souls, you have one owner, but for partnerships, you have multiple owners or partners that are getting together in order to make a company. Now, talking about companies, they all need accounting. So whether they are a sole, like one owner, or they are partnerships or corporations, they all need accounting. Why? Because accounting is very important, especially at the level of identifying the accounting information. We need first to identify it. Then we record it properly, right? By recording it properly, meaning preparing financial statements. And this is not the aim of this training session. We are far from being preparing or seeing how financial statements are being prepared because that's a whole class. And communicating this information, it is very important that you communicate this information. Now, in the case of your next home assignment, it's about identifying basically the inflows and the outflows of cash, meaning your revenues and expenses, where you are generating cash from and where you are using cash at, recording it, doing it in an organized manner, just following the grid or an Excel sheet that was shared with you, and then communicating this information. So far, you need to communicate it to us, basically Ost-M Morocco team. So we need to make sure that you know what you are doing with the cash and you know how you are going to generate the cash and where you are going to spend it. But more precisely is maintaining a minimum acceptable level of cash. Okay, talking about cash, who can tell me what is cash? What do you know about cash? Yes, Amira? Amira?
It is liquidity, the amount of money that you have in your pocket.
Yes, yes. So for the company, yes. For the company, it's about liquidity. And we can say that cash is the most liquid asset that they have. So yes, Thanks to cash, we can do a lot of things. Thanks to cash, we can pay for our expenditures. Thanks to cash, we can buy new assets, we can buy new equipment, etc. Yes, liquidity is a measure, but cash is the that companies needs to have. And especially at the level of startups, cash is very important. It's the fuel of your startup. So yes, so in financial accounting, we report cash as an asset. So we say that cash is an asset, and yes, it is the most liquid asset. And all companies, they need cash. Why they need cash? So that they can run their day-to-day operations. So the purpose of this first home assignment is to forecast meaning to know your future cash positions based on your future inflows of cash and your future outflows of cash, so that you'll be able to know or foresee any potential bottleneck at the level of the cash, so that you can solve it before it happens. So that's why we are talking about budgets, meaning that everything is about the future. And you need, based on your estimation of the future, you need to overcome any potential problem as of now. So this is what we are going to see in these budgets that are called cash budgets. Now, here we have a set of guidelines that are called the General Accepted Accounting Principles. Those are more of the guidelines that we use in order to prepare financial statements. So we need to separate between two things. We have financial statements that are used for financial reporting. Do you know any of the financial statements? Do you know financial statements?
The balance sheet and the income statement.
Right, we have the balance sheet and the income statement, right? And we have also the cash flow statements. So the balance sheets and the income statements, those are financial statements that are being prepared according to some guidelines. Those guidelines, we call them the General Accepted Accounting Principle. Now, for the cash flow statements, it's a statement that is more related to what we are going to see now. So it is an official statement. So we build it using the GAAP guidelines. But what we are going to do in this home assignment is more of a budget. So it doesn't follow a guidelines. You will see that the Excel file was built up in a way that it is easy to fill in and easy to understand. So it has nothing to do with the General Accepted Accounting Principle. Here we have some key concepts that I want to make sure that you already know before we can do this. So we have assets. Can you tell me what are the assets? What are assets?
Those are tangible, I mean, assets or that a corporation can buy.
Okay.
Like, for example, like a building or facility.
Let's stick to your company. You are Spotter, right? So tell me what kind of assets your company might have.
Human resources.
No.
Well, assets it will be. I mean, the building that might be. We can invest on a.
Okay. Build it.
Lands.
And
Machines.
Equipment.
right, great. Equipment. What else?
Inventories.
Inventories, right? What else? So please stick to your company. So just tell me your company and the type of assets that your company might have. What
Or
else?
maybe receivables.
Okay, so you know all this stuff. So accounts receivable, right? This is another asset. So it's anything that the company has, that the company owns. And usually it is used to generate revenues. So this is how we define assets. So it's whatever the company owns and it is used to generate revenues, right? Those are the assets. Liabilities, what are liabilities? What can be liabilities for your startups?
That might be payables.
Spotter, what does your company do? What are the type of revenue?
I mean, we offer like service for corporations to check. I mean, the customers checks instantly.
Yes. So let's stick to the example of your company. What kind of liabilities might your company has?
Well, maybe we want to invest on some laptops for our employees.
Okay,
We need to buy these laptops.
right,
First, this is a payable. It might be a liability.
right. So you bought some laptops, but you were not able to pay them. This will result in account payable vis-a-vis your suppliers of laptops, right? So this is one of the liabilities. So please tell me more. What other companies, your startups, and what do you think you might have as liabilities? What else?
For example, for GlueTech team, we can have as a liabilities laboratories investment. So
Laboratory investments. Can you say more, Muad?
yeah, like we need to spend more investing more for researches.
For research.
Yeah, and we need invest for that.
Muad, let's be specific. So here,
What we have,
Muad,
but
basically, if you invest, if you are going to buy something tangible, that will be an asset.
no,
So
it's not. It's not changeable. Well, like we need. Uh, we are here in passive. It's not action. Like
okay. So you are talking, Muad. So you said passive. Maybe you are talking about expenses, no? Les charges. How are you going
yeah,
to invest in those research and
yeah.
development?
It's more than year.
Sorry?
It's more. It's for more than year.
Yes, research and development can be capitalized. It can be an asset. So if you are creating a patent, that will
Yeah,
be an asset. We call it intangible,
intangible.
right?
Uh,
And
yeah.
over time, Muad, we are going to take parts of these assets and we are going to expense them to call them expenses. More detailed, we are going to call them amortization expense. Right,
Okay.
Muad?
Yeah, I understand,
Good.
Frankie.
So let's stick to liabilities. So tell me the example of liabilities that you think your companies might have.
Maybe a loan.
A loan, right? Thank you for that. If you ask for a loan from a bank, for instance, it is going to be a liability. More precisely, a long-term liability. What else? What else?
Maybe taxes to be paid to the.
Thank you. Thank you. We can have income taxes payable. So these are liabilities that you have, or these are expenses that you have incurred. We'll see this term later on. Incurred, what does it mean? You have incurred it during the year and you were not able to pay it. So now I want you to make difference between cash outflows and liabilities. So
Do
first
you
you,
have a question? I have a
yes,
question.
Ahmed, yes,
It-
please.
Yes, it's Ahmed. Please, I want to ask about assets. Assets is only tangible, or it could be tangible or intangible.
Thank you, Ahmed. There are also intangibles. Yes, in assets, we have tangible assets that have physical existence, and we have intangible ones. Intangible ones, you can think of the
Services.
franchise, you can think of patents, trademarks, copyrights, etc.
Oh, okay. But if we are buying services from someone,
A
I
service.
don't know, it could be like we want to buy a design, we want to hire a designer, freelancer, it could be an assets or not. What you
Well,
are
good.
spending on
Now,
those.
Ahmed, if you buy a design and you want to have a patent on it, yes, then the amount that you are going to pay to this organization that will save or will prevent your design from copying, yes, this amount that will be paid here you are making an asset, more precisely an intangible asset that will be called
But paying the service
trademark.
of creating the design is not an asset.
No, the service of creating the design, that's actually an expense.
Okay, thank
Right.
you.
You're welcome. Great. What else? So please, as we are going through these, if you can think of an item that belongs to your startup and you don't know really what it is, you can just ask me. So this is a step in helping you doing your home assignment. Great. And we have stockholders equity. Do you know what is stockholders equity?
It's actually the contribution of the owners to the company.
Thank you.
Investors ask for equity for percentage. They buy a percentage.
They invest, right? So this
They
can come
invest.
from your personal savings, Ahmed, for example, or what Amira had said, yes. So this is the personal contribution of the individual. So if we have partners, 3 partners, they got together in order to make up a startup, yes, they will invest $1,000 each. So we'll have a total equity that is equal to $3,000. Why? Because each of the 3 partners have invested $1,000. Now, basically, this will make an accounting equation that we'll see later on. Assets is equal to liabilities plus stockholders' equity. Again, if we are going to invest in our company from our savings, $3,000, $1,000 each, so actually we are going to use this money to simply buy the assets. So thanks to this money, we might have some cash, we might have some inventory that we need to buy, or prototypes that we are going to make, or for instance, just having equipment. That's it. So yes, that will lead us to this, what we call the accounting equation. Assets is equal to liabilities plus stockholders' equity. So these 3 components, they belong to the balance sheet, is what we refer in French to as le bilan. They belong to the balance sheet. Now we have this other item, it's called revenues. And they are separate from the first 3. Can anyone tell me what are their revenues, meaning for your startup? So tell me your startup and what do you think will be your revenues?
Can I
Maybe.
answer?
Yes, Abdulali.
So, okay, so maybe first is the service that we will be selling to our users, and we will invoice them, we'll bill them.
Right, right,
We'll sell
Ali.
the service and we'll bill it.
Yes, Abdulali. You will bill the customers for the service that you are providing them, right? So you need
Exactly.
to know, Abdulali, that the moment you will deliver a bill to them, here you are recognizing a revenue. Is this clear, Abdulali?
Yes.
Whether you were able to collect it in cash or not, you call it a revenue.
True.
So this is actually what we call the accrual basis. And definitely we are not going to use it for this first home assignment because we are not going to create financial statements. We are not going to create balance sheets and income statements that are based on accrual accounting. What we'll be doing is basically the cash accounting. So for instance, we'll see in a while in this Excel file, you need to forecast your inflows of cash. So the inflows are not the potential sales. No, it's the cash collected from these sales. And the same thing, expenses. Expenses, what are expenses? Can you think of expenses? And your startups will have definitely many expenses. Anyone?
In raw materials, for example.
Zakaria. Yes, raw materials. Raw materials, that's an expense.
Anything we pay. Anything we
Sorry?
pay.
Yes?
I said anything we pay for to create the prototype or to create the product.
Right.
Since
Great.
any money
Ahmed,
comes out from the
I will
the
disagree with this.
startups, it's an expense.
Ahmed, you said anything we pay. I disagree with this.
Yes.
I would say we incur. Because basically we're talking about accrual.
Okay.
So expenses, they are about incurring an expense. Do you know what does it mean incurring? Mean happening, taking place. What does it mean incur? Meaning it happened. So basically for expenses, we record the ones that are being incurred. And actually we are not going again to use the accrual. So while talking about cash accounting or the cash budgets, yes, we would just talk about the expenses that were paid. And I agree about this one. So we just care about the revenues that were collected and the expenses that were paid, meaning the outflows of cash. Is it clear?
Sorry, I didn't get that. Actually, I didn't understand the difference between cash accounting, like is it in the future, and expenses, it's something that we already...
Mohad, we have here 2 terms. We have the accrual accounting and we have the cash accounting. What you need to know is that accrual accounting is the one that is used to prepare the income statement, where we have revenues and expenses. Yes, Mohad?
Okay.
So what does this accrual basis says? The accrual basis says that basically we just call a revenue once it is being earned. Do you know what it means, Muad, earned?
Yeah, yes,
What is
and
your company, Muad?
blue checks.
Glutech. So can you tell me how this Glutech company can generate revenues? What is the source?
From selling our products is
Physical products, right?
yeah, yes,
You are selling those physical products. So the moment you make the sell, you will call it revenue, Muad, right?
yes.
But does a revenue necessarily mean cash inflow, Muad?
Okay,
No, no,
yes.
no. That was a question, Muad. Does a revenue always means a cash inflow? Do you know what it means, a cash inflow, Muad?
It's it's like I didn't I
Okay,
didn't
Muad,
understand.
Muad, how much does your machine cost? More or less.
So, sorry.
How much does your machine cost? This Glutech machine cost?
Cost like
Price.
for
For how much you are
um
willing to sell it?
uh, like 500,000 $500 dollar.
$500. Okay, so let's say that you are going to take 10 of these and you are going to sell them to a hypermarket. Let's not call a name of the hypermarket, but you are going to sell it to a hypermarket. So you are going to sell 10 of these, meaning you are going to make a $5,000 revenue. Is this clear, Muad?
Yes.
This is the
Now, let's
revenue.
say that you are selling to a supermarket or a hypermarket or a retailer, and then they will tell you, listen, we cannot pay you everything in cash. We just pay you 50% in cash, and 50% will be paid later on, meaning that you will receive $2,500 immediately, and the other $2,500 will be received, for example, in 3 months. Now, I ask you this question: how much are you going to call it as revenue?
But just 15%.
No, revenue
The
is everything.
total amount.
The total amount, Muad.
Yeah.
That's what we call it accrual basis.
Super,
So the moment you just delivered those 10 machines to this hypermarket, you actually here earn the revenue, which is 5,000. However, while doing the cash accounting, what you will record is only this inflow because this is the only amount that you have collected in cash and you
Exactly.
still did not collect the other one. Is this clear, Muad?
Uh, I think so.
No, it should be clear, not you think. If it's not clear, you ask me which part is not clear. Did you get the
So
difference between accrual accounting and cash accounting?
accrual accounting is it when when I have like already $5,000 and
Yes,
cash accounting is just the
the cash that you
50%.
have received, the cash that you
Okay,
have received,
so
right?
I think I got it. Like
Great. So cash
like
accounting is more about inflows of cash and outflows of cash.
okay,
So this is what we are going to do. Is basically you are going to prepare a forecasted budget for cash, and you are going to see what are the potential inflows of cash. That's meaning that which will increase your cash basically just from revenues that you are going to collect. And basically you are going to make a budget for the outflows, meaning where you are going to spend the cash.
Sorry.
Yes, yes,
thank you.
Yes, in cash accounting, not all inflows are revenues actually, because like loans are inflows, but they are not revenues.
I agree. So loan is another source of cash, but your main source of cash should be revenues, right? Is this clear, Simon?
Yes, it's clear.
But I agree. In order to have sources or inflows of cash, not only loans, what if you have sold some old machines or equipment? That also is going to be an inflow, but that's not from your main operations. Is this clear?
Yeah, so the biggest part for inflows, it's the revenues for cash accounting.
The biggest part, yes, your main part should be the revenues. If you are going to borrow money, that's another story. I mean, if you see that your revenues or the inflows from your revenues are not enough to cover for your outflows, then you might predict this potential bottleneck. So you need to borrow, you need to make or to have a loan. So you can forecast that even before it happens. Is this clear, Si Mohammed?
Yes, it's clear. So we don't move to the option of loans unless like we are really like the inflows are less than the
Or
outflows.
you are, yes, or you are planning to make a capital expenditure. Let's say that in 3 months you are forecasting that you need to buy a new machine. And from your budget that you are going to prepare, you can see that during the first 3 months, you don't have enough cash to cover for that capital expenditure. Of course, you need to make arrangements. Either you ask for personal contributions of your partners or business angels, or to formally apply for a loan. So it's all about the future. Yes. So thanks to this budget, you might be able to forecast bottlenecks at the level of cash before they even happen.
Thank you. Yes, it's clear.
Great, great, good. So here we have some assumptions about the gap, right? The general accepted accounting principles. So they say while you are preparing the financial statements, you need to keep in mind these assumptions. Now, what I want you to keep in mind is that we have this going concern. This one is mainly about how do we value our assets. So they say that even if you have in mind that your business will shut down in 2 years, this assumption should not impact the way you are going to value your assets. So going concern, monetary unit, of course, your financial statement, they should be in one monetary unit. They cannot be in quantities. For example, for inventory, if you are going to buy, I don't know, 10 kilograms of plastic, it should not be as plastic, but it should be as monetary unit in, for example, in Moroccan dirhams or in American dollars. And the time period assumption, we will see that you are going to create or make this cash budget for a time period. So basically 1 year. This 1 year is divided into months. So basically we'll have the cash budget for the whole year, but this cash budget is divided into all the 12 months where having an amount that is pre startup, meaning while preparing for the startup, what are all the outflows that you need to make or the expenditures, and then that will be your starting point for the whole upcoming year. And we have the business entity assumption. This assumption says that basically we cannot mix up different entries for different businesses. So if we have Spotter and Glutech, those are two different entities. So if we are making the budget, it should be for one entity each, and we cannot mix up the two. And one important thing I want you to, while preparing these budgets, I want you to keep in mind that we need to separate the owners, which are basically you are the owners of the business, from the business itself. So we have here two separate entities. So we have the founders, we need to separate them from the business. So while talking about the cash budget, it is about the startup only. So it has nothing to do with your personal revenues or your personal expenses. So keep this in mind and make sure that you will separate the two. Now, basically, what I will be talking about next is simply the home assignment. So in this home assignment, what you are actually required to do is a cash budget. So as we have said, this cash budget, it is simply a forecasted budget. So you are forecasting it in the future, and you are going to ask yourself, what are different revenues or cash that inflows that you are going to make in the upcoming months, and what are the potential outflows or of cash that you are going to make these months. And then you have your cash budget. So this is what is a cash budget. And this is what is your home assignment is about. Now, before moving to the cash budget, which is this one, you need to know that in order to do it properly, in reality, how it is done, it belongs to something that is called the master budget. So what is this master budget? Is nothing but a set of multiple budgets. This is a master budget. So it's a set of many budgets. So the starting point is first you need to budget your sales. So this is how you can make a cash budget. Why? Because we will see that cash budgets relies on revenues, on how much sales you are going to make and how much of these sales you are going to collect. So yes, this is your starting point. So I believe at this stage, you are able to forecast of how much sales you are going to make for the upcoming year or the first year. And based on the sales budget, you will be able to make what we call a cash budget. And you can see that things are related. So this is mainly for manufacturing companies or manufacturers. So in order to make the sales budget, you need to have the production budget because they go together. I mean, if I'm planning to sell 10 units every month, basically I need to be able to make these 10 units. Since we are talking about the future, so I need to set my production budget that goes in line with my sales budget and vice versa, the ending inventory budgets, etc. But what I want you to keep in mind is that yes, it will take you a lot of time to think what will be included in this cash budget. So it's very crucial decision to know all your inflows and mainly all your outflows and make sure that you don't have surprises. So try to make this cash budget very comprehensive so that while you start running your business, you will not have surprises that might lead you to have a negative cash balance. And then it will be a problem. Why? Because you will end up having bottlenecks, unpredicted bottlenecks. Now, in order to prepare this cash budget, we have some guidelines. These guidelines, they were summarized in a Word document. I think it was shared by Miss Lena. She did put it in your drive. You can find it in there. So there is a 5 pages Word document. I urge you to read it. It has all the details about what you need to include in this cash budget and different steps that you need to follow. So, can your business make money? If so, how much capital you will need to get off the ground? So here what we are referring to is the pre-startup, the pre-startup. The pre-startup expenses. Now, for pre-startup expenses, those are simply any expenses that you will incur or any outflows of cash that you must make before even starting the startup. Can you think of any potential expenses that you might be having? Maybe starting now, you are already having these, or that you can forecast that you will be having as pre-startup expenses.
Uh, the location.
The location, yes, Yasmin. What about the location? Now, the location, it depends. If you are talking about owning the place, that's different from renting the place. Can you be more specific, Yasmin?
Well, I think both of them are gonna be an expense.
Not really. Now, if you own the place, if you own a building, Yasmin, that's basically would be called an asset. And every time we will take part of it, and we will call
But
it.
I think for a startup, Professor,
Yes, sir.
Mr. Harris,
Yes, sir. Yes, Ahmed.
can I ask a question, please?
Okay, let me just clarify Yasmin's issue, Ahmed. Then
Yeah, for the startup, it's a little bit to avoid owning a building.
right. So you can have leasing. That's better. You can rent.
Oh, okay, sorry, I think there is connection.
Ahmed?
You have some connection issues. You can clarify Yasmin's idea.
Yes. Yasmin. Yasmin?
Professor.
Yes. So did you hear Ahmed's point? Ahmed has a valid point. He said that in the case of startups, we need to avoid making huge investments, unnecessary investments. Like in order to buy a location, an area, whether it's an office or a working shop, basically it is expensive to do that, especially for a startup. So you rather rent. Now, while renting, yes, you can consider the rent expense that you are paying or the monthly rent that you will be paying before even starting the business, maybe where you have meetings with your partners, that area you need to pay rent for that. So that can be a pre-startup expense that you need to pay and you need to account for. What else? What do you think some of the pre-startup expenses or costs that you are having?
Maybe market research study.
Thank you, Avladi. Maybe you need to do a market study. Maybe you need to hire an agency that will do for you surveys or feasibility of your products or market study. And of course, these expenses or whatever amount you will pay for these market studies, they are pre-startup, means even before you start operating. Great. Can you think of something else?
A patent?
A patent, right? So a patent. Now, if you develop some tools or maybe some machines, in the case of glue tech, if it is your invention and you want to have it protected, so maybe you can think about registering it and having a patent on your invention, right? What else? People, are you still in here?
Yes.
Uh, salary also, salary of employee.
Right. Now, if you have some employees who are working full time before even starting to run your operations, of course, you need to pay them their salaries. So we call them salaries and wages. If you have a security guard in your warehouse where you are just making your prototypes, you need actually wages expense, etc. So here we have actually two outflows or two costs. We have a cost to start the business or to start the startup, and we have a cost to run the business. So we need to separate these two things. If you are going to start the startup on January, let's say 2021, now in here in this period is actually what we call the pre-startup. So what we want you to do is first to try to estimate your pre-startup expenses and outflows, which is the cost to start the business. And then second, you need also to forecast your costs to run the business. And these two are different. To start the business means you just are setting up your startup and whatever costs you are incurring and whatever expenses you are paying for. And then step number two is running the business. Now, the advantage of having the second phase while running the business, basically you are having some inflows. You are generating revenues from selling your goods or services. But in this pre-startup phase, basically you don't have many cash flows unless you have personal contribution as an inflow from your partners, or you have a business angel who did give you some funding, or basically if you opt for a loan. These are the sources of your inflows. But basically in step or phase number two, you are having potential revenues. You are collecting revenues from selling your goods or services, and that will be actually compensating for your expenses or the outflows for the expenses. Any questions or remarks?
So I need just to mention here for the running period, we need maybe to consider our working capital, even if we
Sorry, Ablari?
maybe to consider here, we need to consider working capital
Where? In which period?
in the second period. So
I
example,
agree. I agree. You mentioned the working capital, Ablari. Good point. So what is this working capital, Ablari?
or for example, if you bill your customers and
Right?
they will have payment term for example, 90 days.
Yes.
And if your supplier will invoice you or bill you, and if you're not able to negotiate favorable payment terms, for example, we'll have 60 days. So here we need to finance this gap between
Great, great.
the customer.
Great, Ablali. So here, basically, the working capital can be measured by, this is how in accounting it is being measured, by current assets minus current liabilities. In other terms, you are just willing in here to match your current assets, like what Ablali have said. For instance, he said if we sell some goods or services on account, mean we don't collect the cash on the spot, here we are creating receivables versus buying inventory on account where we are creating payables. You are willing to match the receivables with the payables, and you need to see whether your receivables and your cash position will be able to cover for your payables or not. If it's not, mean if you have a negative working capital, that's a problem. Why? Because you are forecasting here a potential bottleneck for cash, and you can forecast that your cash balance will go negative, below zero. And this is a problem, meaning that here you have some discrepancy at the level of cash and you need to cover for it. So either you can do that ahead of time, either by borrowing or raising personal funds from your own savings, or ask for funding. So you need to forecast potential negative working capital or going in red, going below zero at the level of your cash balance. So this is the aim of this cash budget. Any questions or remarks? Something is not clear? Okay, so the steps for your homework assignments. So step number one is phase one, which is the startup costs, meaning any cost that you will be incurring since day one, since day you decided to have a startup until you are about to start the business. So all these costs, we call them startup costs, and they are summarized in this file, which is called startup expenses. I think you already have this file in your drives. So in this Excel file, we'll go visit it in a while, where we have all the possible startup expenses that you might be incurring or that you have paid for. But actually, this list is not, of course, comprehensive. Why? Because we try to make it so, but in reality, you might have some expenses that are not part of this file. So you need to add these expenses to make it comprehensive. So first, you need to fill in this startup expense file, and you need to list all your expenses. Then step number two is file number two, which is forecasting your ongoing working capital needs for the first 12 months. What do you mean by working capital needs? Now, what your friend did say, that if we can forecast that our cash balance will undergo or will go below zero and it becomes negative, we need to solve the problem as of today, T0. Why? Because we have 12 months to forecast. So it's a whole year that we can forecast. This year is in the future. So if we can see that in this period, for example, in month number 6, we are going to go below the cash balance, let's say a negative $1,000. So this is a problem. So since this will happen 6 months in the future, we can even adjust to it and forecast it in here. So in order to not have this $1,000 below zero, we can here do the necessary funding, acquire a loan or personal contribution of 1,000 so that we can overcome this one that will happen in 6 months. So it will not happen. So here, the worst case should be a zero balance rather than a negative one. We'll see also the sales forecast. But now I want to just to focus on these two files, which are part of your home assignment. You need to complete these two files. First, the startup expenses, meaning expenses that you are incurring or that you need to incur before starting the startup. And second one is basically the 12-month cash flow forecast. So now it's time to break out the rooms. So I will ask Ms. Umayma to allocate the teams to their rooms. And then I want you to just open these two files, these two Excel files, and you start having a look at them. So try to think of how you are going to fill in those files and how to include all the expenses that you are going to make.